maybe there's a little bit of disinflation now because if you go in a recession, I mean, even in the 1970s, a recession did cool inflation temporarily. But then I think the question is, what is the policy response to any recession in the United States? And it's likely to be pretty darn inflationary.
Welcome back to Metals and Miners. I'm your host, Gary Bohm. Today, we're diving deep into the volatile world of the Federal Reserve, the markets, economy, and precious metals. I'm thrilled to introduce David Hay, recently retired Chief Investment Officer with Evergreen Govcall, an independent registered investment advisory firm serving high net worth individuals, families, and endowments. With over 45 years of Wall Street and markets experience, David brings a wealth of knowledge, sharp perspective on navigating today's rocky financial landscape. David, it's an honor to have you back on Metals and Miners. Welcome to the show.
Well, thank you, Gary. I don't know how much of an honor it is, but like my friend Kevin Muir says, I bring actually 46 years of financial mistakes to this podcast. So
Okay.
yeah, might as well learn from other people's mistakes, right?
Yeah.
I've made a whole hassle of them.
Well, you made a good career, so I'm pretty sure that you made a lot of good calls as well. All right. So, David, you have decades of markets and economic experience and in guiding high net worth clients through various cycle peaks and troughs. Today's consumer, economy, and debt situation seems to be perilously close to the edge of the proverbial cliff. What do you hope for those tuning into our conversation today that they will walk away with after listening to our discussion?
Well, I guess I would probably use a little bit of a cliche and say the great disconnect, which is this deviation between very frothy asset markets, at least in the United States. I know it's less that way in Canada, but in the U.S., it's pretty crazy. And I think you have a lot of Canadian viewers, right? Am I assuming that correctly? Maybe even the majority. But I'm sure a lot of these folks, even if they are north of the border, they still own a lot of U.S. stocks, and they probably are pinching themselves. But this year, anyway, they're pinching themselves even more if they're long the gold miners. So, I mean, some things I think make sense. I mean, I think given what we're seeing in terms of just the global monetary and fiscal trends, I think it makes sense for some parts of these areas, like the gold miners, to be very strong. But when you look at, like I emailed my friend Louis Goff today about this reversal down in Argentina, where Milei he's having to deal with the Peronis again. And I'm like, well, geez, won't it ever die in Argentina? He goes, well, what about in America? We seem to be going with Peronism in America all the more day by day. And there's a lot of truth to that. And it's just like, okay, well, how does that square with an S&P trading at one of its most inflated valuations of all time? It just seems odd. And then, you get the Treasury market, which is rallying a bit here lately because of the bad economic numbers that have been coming out. And as you're probably aware, the number that was reported today on the quarterly census of employment and wages, QCEW, which is a big deal. Secretary Bessent was warning about it yesterday, and he said it might show 800,000 jobs fewer than originally reported. Actually, it was 911,000 jobs fewer than originally reported. It's 2 years in a row now we've had these big downward revisions. And that's been a favorite theme of mine, is that the jobs numbers have been grossly overstated and not nearly as robust as what they were officially reported as, which had Wall Street, dancing a jig, and now they're ignoring. So I think, it's just that's kind of the critical market. If the jobs market breaks, and I don't think it's conclusive that it is, but I think there's a lot of alarm bells going off right now. That's a big deal economically. So that could really, kind of create a reality check between the financial markets and the economy itself.
Yeah, all good points. And, the number that they came out with, 911, is so interesting. 911, 911.
Yeah.
Wonder if there's any coincidence there. Okay, well, anyway, so Japan's prime minister resigned last week. France's prime minister was ousted as he just yesterday or 2 days ago, as he wanted austerity. And it seems as if France is about to double down on their massive debt. President Trump wants the federal funds rate to be reduced by 300 basis points, and he's already gotten one FOMC member changed out. He's working on a second, Lisa Cook. And Chair Powell's almost assuredly to be replaced come May. The Doge austerity effort here in the States is a distant memory, and it seems what is before us is lowered interest rates on the short end and loads of printing. I mean, like lots of money printing. And the same likely goes for the other Western nations as well. Is this what you see coming? And if indeed this is the case, what are the ramifications that you're expecting?
Well, I think it's a very supportive environment for hard assets. And it is kind of, in fact, we wrote this up Tale of Two yesterday, and you can just look at, the gold, silver, miners, and just the metals themselves versus, say, energy to see these, this 180 degrees opposite scenario. So being the contrarians that we are, I am, I'm quite interested in energy. We'll talk about that more later, but I think that just having real things that aren't just a figment of a central bank printing press is essential. I mean, we make the point all the time, and there's a lot of euphoria in the U.S. about how the S&P has done so far this century / millennium. But if you price it in gold instead of in fiat dollars, it's a bear market. It's a 25-year bear market. Nobody's, well, who does that? Who looks at stocks and gold prices? Well, actually, quite a few people do. JP Morgan, as you probably know, famously said that gold is money, everything else is credit. And I think he'd be, just horrified to see the amount of credit being created today. So it's, I think it's important to look through the money illusion that these tremendously inflationary programs have created. And do I see that changing? I mean, realistically, we've got, if the economy's slowing, you can make a case that interest rates should come down. I think what you said earlier, short rates going down quite a bit, and longer rates, much more of a question mark. So what you're really seeing, and we've been fortunate to point out some of these yield curve steepening plays like AGNC, the big mortgage REIT, some of these things that benefit from the short rates going down, long rates being more stable are pretty interesting. I know a lot of institutions are playing sophisticated games for a yield curve steepener, but that's a pretty simple way. I will say it's gone up, about 10% or so since we first mentioned, which for a yield play is pretty darn good, but it's still yielding like 12.5%. So I think you just have to accept the environment you're in. I think it is the bias is towards inflation long term. Maybe there's a little bit of disinflation now because if you go in a recession, I mean, even in the 1970s, a recession did cool inflation temporarily. But then I think the question is, what is the policy response to any recession in the United States? And it's likely to be pretty darn inflationary.
Yeah. Okay. So you made an interesting point about the S&P.
I did? That's fair.
You actually made several, but I wanted to point out one. The one where you say that the S&P priced in gold is actually in a bear market for the last 25 years. Do you expect the S&P to continually to show nominally, but in gold terms to be lagging behind gold? Do you see that environment moving forward?
Yes, I even think there could be a period here where the S&P does very poorly in nominal and worse in real terms for a while. But what I think we're probably going to see over the balance of the decade is the S&P kind of going sideways in nominal terms. Sideways that maybe slightly up, but down fairly significantly. Especially, the inflation rate, is that really the best way to adjust for money printing? Probably not. I think there's a lot of questions about the accuracy of the U.S. CPI calculations right now. You probably have seen shadow stats, and
yeah, I had John on the show. Yeah,
so he's probably highly skeptical of the CPI. I know Rick Rule is, who I'm sure has been on your show. Anyway, yeah, I think that's probably the likely scenario. So maybe kind of flattish nominally, but down in real terms for the stock. It's a very expensive stock market.
Yeah, but
And it's
in
due to
20
have a mean reversion, and I know that we have the AI craze, but I think AI is becoming increasingly suspect in many ways.
Yeah.
But particularly for these companies that are investing hundreds of billions of dollars, literally. I mean, there's probably going to be $1 trillion invested in AI, by corporate America here relatively soon, and they're really not getting the kind of return that you would think they would to justify that kind of outlay. And you've even got Sam Altman saying he thinks it's a bubble, and then with the MIT study, and it's like 95% of corporate America is disappointed in what's happening with their AI. And so I think that AI is probably going to that the bloom is off that rose. We're probably going to see a fairly significant market correction at some point here and whether it's this fall, as we know, October's can often be a major bottom and then a big rally coming out of, say, mid-October to late October. But this is the time of the year when accidents do tend to happen. And right now somebody I think it was Stephanie Pomboy made a great point that if you went back to 2022, there was such utter conviction we were going to have a recession. Now you do a recession search, and it comes up with fewer results than if you search on Kamala Harris. And, she's gone pretty much missing. So it's.
But you bring up 2022. We did see the dip of 2022, 23% in the market during that time. And the following year, we saw tax receipts drop pretty substantially. Do you think that they'll pull out all the stops to ensure that the markets at least go sideways so that tax receipts don't dip when we have this, $2 to $3 trillion deficit already?
Yes, I think they'll pull out all the stops if they need to, but we're far from a crisis right now. So you're going to have some kind of a repeat of what was going on this past spring, or like you said, in 2022. And I wouldn't be surprised, especially if the Fed is controlled by somebody that's, pretty much under Trump's thumb, that the Fed would or the Fed/Treasury would buy stocks during a really adverse market period. And if the prices were really down and there was a need to stabilize to prevent, a cascade effect, that maybe wouldn't be a bad idea. And that's what the Hong Kong Monetary Authority did in 1997, 98. And they made a killing because they bought into an absolute panic. But first, you got to get the panic. And my fear is that once these guys start doing these kind of extraordinary rescue programs, they have a tendency. It's one thing if things are, it's really a 5-alarm fire. It's another thing if there's just, a little blaze and, in the fireplace that's gotten outside of that. And, they still bring in all the fire trucks and hose with liquidity. And so these minor events seem to trigger outsized reactions. And that's not great for, I think, the society at large, but it's really good for hard assets.
Right. All right. So, David, we've been talking about the Fed here. There's now an 82+% chance of a 25 basis point cut at the next meeting, September 17th. And the odds of a 50 basis point cut have more than doubled over the past week to about 14% now, according to the prediction market, Polymarket. What signal would it send if the Fed ends up cutting 50 basis point, and what impacts do you think that would have?
Well, that's a great point because there is this view that interest rate cuts by the Fed are always bullish for the equity market, but that's really not true. And all you have to do is go back and look at 2000 to 2002 and 2007 to early 2009 when the Fed had been cutting frantically in both cases, and yet we had vicious bear markets. And of course, the second time we also had the massive real estate bubble pop. So I think this kind of Pavlovian view that lower interest rates are bullish for stocks is too simplistic. I think if it's a series of moderate cuts because it's kind of a soft landing type of thing, that is somewhat bullish. But if it's a bunch of panicky rate cuts because the Fed feels like they're now behind the curve and the jobs market is getting away from them, that's when the rate cuts can actually be negative. You probably get an initial celebration, but then as time goes by and there's more evidence that the reason they're cutting is because there's problems, then that's when you get the next down leg. So yeah, I think and the other thing too is look at last year. I mean, they cut 100 basis points and long rates went up. And I think that's the dilemma. In fact, I think as Luke Groman said, be aware that in many of the OECD, rich countries, you've got falling industrial production and rising long-term interest rates. That's not a good sign. That's kind of a sign that the developed world is going developing. And it's, again, I don't think that's priced into the market. So yeah, I think it's a dangerous time for a lot of investors. And I think it's like, go back to what does Buffett always say? Be greedy when others are fearful and fearful when others are greedy. Well, there's a hell of a lot of greed out there right now. So I think a prudent investor should be, kind of checking in with their fear tolerance or their risk tolerance.
That's a good point. So President Trump replaced an FOMC member a few months ago with his own guy, Stephen Moran. Now he has his sights set on replacing Lisa Cook. He'll then replace Chair Powell by May of next year. and who knows, maybe there's going to be a couple of others in between. Regime change at the Federal Reserve is clearly underway. How much risk to the economy and asset markets over the long term is structural regime change at the Federal Reserve, and what are those risks?
Well, I think the risk is a 1970s kind of replay where you do get these periodic cooling off of inflation periods, but then as the economy, reaccelerates perhaps with a lot of policy support, then inflation comes roaring back. And I mean, let's face it, the Fed is easing, has already eased and is going to ease again at a time when unemployment is still, historically low, so it's certainly deteriorating. And you could say, well, they're just trying to be ahead of the curve. But you've also got wage increases still running over 4, and the core CPI that they like to follow is uncomfortably around 3%. I mean, they haven't hit their target, and they're still cutting.
Yeah.
So it is already a different Fed, and there's just no question, as you were describing, that Donald Trump wants easy money at the Fed, and I personally think that the Fed has been too easy most of this decade, and well, not this decade, this century, and we paid the price. David Stockman ran a really interesting chart the other day. He kind of, I thought, a bit misinterpreted. It was basically looking at the amount of debt that had been increased under kind of the Greenspan, Bernanke, Yellen, Powell regimes. And certainly it went up, but where it really went up was ironically from 1980 to 2007. And then since this is not government debt, obviously government just keeps going up and up and up. But this is looking at total U.S. debt to GDP. That's basically flatlined for 18 years. So really what that tells us is the money explosion or the debt explosion happened really previously, and it's gone up, and so as the economy's grown. But it was a really hockey stick, and I think that corresponded very clearly or closely with the housing bubble. And now we've got another housing bubble. And if we want to talk about what's a threat to the economy, I'd say the jobs market deteriorating faster than people were expecting, but also I think the housing market, because there's an awful lot of complacency about housing.
Well, let's talk about the jobs market. David, last week brought a wave of disappointing labor reports, starting with the JOLTS report for July, which showed that job openings declined by 176,000 to 7.2 million. And that was a 10-month low. For the first time since the pandemic, there were more unemployed individuals than available job positions. Then came the weekly initial jobless claims report. That revealed a higher than expected increase of 8,000 claims, bringing the total to 237,000. And then the non-farm payrolls report for August came, which showed that only 22,000 jobs were added, far below the forecasted 75,000. And now today, job growth through March of this year was revised down by 911,000 jobs. With these weak reports adding to a string of disappointing employment data in recent months, it is becoming increasingly clear that the U.S. is experiencing a job market slump. Is a recession upon us, and do you expect the aggregate standard 3.6% unemployment uptick during this time, or do you expect this to be worse than the average over the last 50 plus years?
Don't know on that one. I'd say it's possible, but you don't have to have that kind of that's a pretty huge increase. If you're saying that 3.6% from here, which would push the jobless rate to what, around?
Well, it would probably be from the bottom, which was 3.
From the bottom,
I think
so that'd be
3.6, 3.7.
That'd make it about 7% if it went
Yeah.
up 6% from the bottom. It could certainly happen.
Stan Druckenmiller called that the garden variety recession.
Right. Yeah, I mean, I do think that there are some differences. Today, obviously, the amount of the labor force is shrunk. At least the unofficial labor force is shrunk with all the deportations. I think there is a reluctance on the part of a lot of corporations to fire people. I think what you're really seeing is the hiring drying up, but firing's going up too. So that's kind of really the first time we're seeing that. Since you brought this up, I'll just show you a few quick images here.
Yeah, and while you're pulling that up, I do have an extra question for you, and that is, if we do have a prolonged unemployment period, let's say a downdraft in job openings and an uptick in job losses over maybe over a 1 to 2 year period, with AI getting smarter and better and more efficient, do you expect this cycle to be a little bit more difficult for folks to retrain and get back into the workforce on the back, a year or two down the road?
Yes, I think absolutely. In fact, I've got a visual here that I think is pretty sobering in that regard. This is just a few quick ones, just indicating the weakness of the jobs market. And what you can see from several of these, we're basically at recession levels already. In fact, this one here, 2-month payroll net revisions, and it's something that was a theme we've been harping on for really the last couple of years, is watch the revisions. Don't pay attention to these, these numbers that come out on, first Friday of every month, because they're almost always revised downward, at least over these last couple of years. So this is the one that really is to your point. You look at what's happening, unemployment for new entrants. So these are young college people, and this is where I keep reading, and it makes sense that where AI is really wreaking havoc. So, from a societal standpoint, to have these young college grads coming out and not being able to get a job, I don't think that's good for a variety of reasons, including how much student loan debt they're carrying in many cases.
Yeah.
And this just gives you it's just the trend of what's been going on. I mean, this isn't new. We would say that actually, if the numbers had been reported more accurately over the last couple of years, the jobs market would have been viewed much more cautiously than what we heard. It was an awful lot of Wall Street cheerleading, and of course the White House cheerleading when those job numbers were coming out strong, but they weren't real.
I think they were revised downward something like 14 out of 15 months in a row, or 15 out of 17. I mean, it was unbelievable. Every month they came out, and then they revised, 2 months prior, 3 months prior. You couldn't trust anything that they were saying.
Well,
So,
also anything along those lines is the leading economic indicators. I mean, they've been in like a over 2-year bear market, one of the longest bear markets ever for the LEIs, and they are called leading for a reason. And that's despite a strong stock market, which is one of the inputs. So yeah, I totally agree that this, and what concerns me is the opposite. I really didn't finish my thought. And back in 2022, everyone was on recession high alert. Now they're not. So if you do get a recession, some of these job numbers, just people go, wow, this is just looking like, the negative people were warning us about, that when the jobless rate starts to run, it just spikes. And if that kind of mindset starts to set in when there's such complacency, that's when you get the violent market reactions.
okay. So after the jobs report came out last week, David, it was negative, showing less jobs obviously created than expected, and an increase in the unemployment rate. In response, the Dow, the NASDAQ, and the S&P, they all turned negative, while gold, silver, and the miners, they all turned strongly positive. Is this a setup that you would expect moving forward, the softer the jobs market gets and as the Fed cuts?
Yeah, probably. I think that, again, the belief is, and I think correctly, sometimes you want to agree with the consensus. I always get nervous if I find myself agreeing with the majority view, but if we do have even a slowdown, much less a recession, the Fed's going to be very easy. And I do think that Besant is a pretty clever dude, and I think he's going to come up with ways to support financial markets, even the bond market. But I do think the risk is that long yields go up at a time when short rates are falling. I think that's something we have to watch very closely. That's been going on, as I kind of mentioned earlier, but for the last couple of weeks, there's been a pretty healthy bond rally. But that's what people like Jeff Gundlach and Stephanie Pomboy have been calling the Pavlovian bond response. You get these weak economic numbers, and just boom, the rates go down, bond prices go up at the longer end of the curve. But then, kind of the harsh reality dawns on people that, but what does it mean if we have a recession when we're already running deficits at 6 to 7% of GDP? Then we have a recession and they go to 9 to 10. So you flood the market with Treasury offerings, and frankly, Besant's having the same trouble that Yellen is. He's issuing very little long-term debt. It's almost all with T-bills, and T-bills can be they're great in terms of being repoed and hypothecated, and they can be pretty high-powered money when they get recirculated through the system. They have as you're probably aware, they have a higher multiplier rate for lending than do longer bonds, which kind of makes sense. So I just think that, yes, you can get these periodic kind of cooling off periods with inflation and the economy, but there's just so much money out there, and so there's such a political desire to kind of inflate things that I think that's what you bet on.
So you bring up another interesting point. Yes, I'm ringing the interesting point bell again. On the long end, you've mentioned it a few times. Is there a number here? Is it 5%? Is it 5.5%, where we run into a crisis point? And if we run into a crisis point and folks start turning away from the long end, are they going to turn to gold?
Well, certainly the central banks are, and that's the biggie, is that they have been buying gold as their reserve asset of choice and basically divesting or avoiding treasuries. And that's an epic shift. And I think that's one that's got legs. I don't think that's just a short-term phenomenon. Now, will the professional investment community shift accordingly? Tougher call. I've seen some huge numbers if just 1% of the bond market moves over to gold, but whether that'll happen or not, I don't know. I do think there is a distinct possibility that we could get a revaluation of gold to 5,000, 10,000, maybe even much higher. What I do think is coming too is what I've been calling a two-tier bond market for a couple of years. So you could actually have some part of the Treasury market that's guaranteed or backed by gold, which will carry a very low interest rate. And that's what it would be in the government's interest to get gold to a much, much higher level to make the gold reserves much greater so they have more gold to back treasuries with. And I think stable coin is going to be another way they do that. So I would expect some very, very clever maneuvers here in the next year or two. But I think at the end of the day, they will tend to be beneficial to hard asset prices. Gold has gone up so much, it's a little hard to be pound on the table. But I just said, there is this call option of a monetary reset, whatever you want to designate it as. I do find things like palladium and platinum and kind of the producers thereof more interesting right now than even the gold miners, which now I think today on GDXJ we're up 100% for the year.
Well, David, here's another interesting thought. With the bond market being in a bear market for the last several years, and with the long end likely rising as we issue more debt, if the stock market flatlines like you were talking about or sells off a little bit, there's going to be a lot of money managers out there looking for gains, and they're not going to be putting it likely into the bond market because it's in a bear. So what is their options? It's rather limited. And if there's any inkling that there's going to be even a under the cover revaluation like you were just talking about with gold in order to support better, why would they not take some of that off the table from the stock market? And because they are not going to move it into the bond market because it's in a bear, they shift over to gold.
Well, I don't know if Gary, you saw that Tether announced here the other day that they're going to use some of their stablecoin reserves to buy into the gold space.
Yeah.
And then I heard Jim Cramer, just almost euphoric about gold, saying he's a gold bug, which I never realized about Jim Cramer before. And don't ever sell your gold. And so that's kind of stuff makes me nervous in terms of a near-term correction. And you look at these charts of some of these gold miners, and they're just so extended. That doesn't mean they're going to go into a bear phase. I don't think so. I think that we're in a long-term bull phase for pretty much everything gold related. But they can still have some nasty corrections. And I remember in 2020 year when they were first really doing MMT in force. So you had the massive amount of Fed money printing combined with the Treasury sending money directly to people. For all intents and purposes, it was full-on debt monetization. And gold and silver prices and the miners went absolutely bonkers for that reason, which made a lot of sense. But then they went through just horrible corrections. So, and we sold into that. I mean, we didn't get out completely, but we took huge profits back in 2020 and kind of doing the same thing again.
Well, let's speak into this for a moment here. So the miners, like you said, they've been on an amazing run, David, in 2025. The setup seems to be the perfect storm, really, for all the reasons you were just talking about. Many investors, they're starting to get worried, as you are, they want to take profits, as you're saying. They think it's getting long in the tooth. But David, as long as the metal prices of gold and silver stay elevated and energy prices, the cost of production stay lower, that like they have for the last couple of years, then forward earnings for the miners should remain high, right? So that's a strong position for the mining equities. What are your thoughts there? Here we have a deteriorating environment, economy, and potentially on the tech stocks and already in the bond market. And we've got low production costs and higher sustained metal prices. What are your thoughts there for strong forward earnings moving forward here for at least a couple of quarters?
Yes, I agree. It's just like we were talking before we recorded that it's, what's concerning is with the cyclical industry, when you get into very strong profit periods, the PEs compress a lot, and they start looking really good on a PE basis because the margins are so high, but they really become unsustainable. I don't think we're there yet, but I think that's going to happen at some point. And I think what you'll see, unless we get that revaluation again, if gold's 5,000, 10,000, I mean, we're in early innings. So you tell me what gold's going to do, I'll tell you what the miners are going to do. But
Right.
of course, nobody knows exactly what gold's going to do. But I mean, frankly, it's had kind of an impressive move here lately. It didn't, when
Yeah.
it corrected to a very mild degree. And I think if you look back at gold tops, they don't top, with this kind of gradual or controlled correction and then another up leg like we've seen here recently. To me, this looks like just a continuation of this tremendous route. And one thing that, I'll admit the mistakes we made. We've made plenty of those, but one we certainly got right was the breakout above 2000 by gold early last year.
Mhm.
And I think what drove a lot of people crazy is as gold was running, the miners were doing nothing. And so an awful lot of people gave up on it, but then they broke out too. So, that's another way you can play the game is if you don't want to be in value traps, look for these things that are breaking out. And in that regard, I would point out both platinum and palladium and also silver. And silver had a great breakout here recently, and I think some of the silver miners look really interesting. Some of the
I'd
guys.
like to I'd like to add to this, and that is, while they've had a great run, but like you have said a moment ago, you don't see the central banks buying of gold stopping. This is a phenomenon post pandemic. This didn't have they were not buying at this level back in 2020, the last run, or 2016. Those two smaller runs that were very impressive during those periods of time had lower metals prices and did not have what I would call like a backstop of purchasing of demand by the central banks. Those are two very important distinctions that are now versus those two previous times.
I agree. I agree. No, I like this setup. I think we're in a secular bull market for precious metals. It's just that it's not, I mean, maybe we're early innings. I don't think so. I think it's more like middle innings, but that's really just kind of a guess on my part. And you mentioned energy, and yes, the low energy prices are really a boon for the miners. So that's kind of a nice portfolio hedge. I look at my own portfolio and my miners are just making me tons of money. My energy stocks are dogs for the most part. But someday I think that's going to reverse. And really
Yeah,
where I see
I do
tremendous
too.
value is some of these energy producers, particularly natural gas. Stephanie Pomboy had this great line a couple of weeks ago that if you love AI, you really need to love energy because AI is such an energy consumer.
Yeah.
And natural gas in particular is quite depressed and way below what it trades for throughout most of the world. It's even cheaper, of course, in Canada. So I think there's a plenty of opportunities in the hard asset world. And a lot of people say, well, if I can't buy bonds, what am I going to buy? Well, how about buying one of these great midstream companies like Enterprise Products, EPD, does generate a K1, but you get a 7% yield, and it's a real yield because they raise their distribution at least at the inflation rate. It's actually been a lot higher than the inflation rate. So there are places to go even for cash flow that you don't have to buy a 30-year Treasury.
Yeah. Yeah. That's a great idea. Well, this has been an incredible discussion. I just want to welcome everyone who's tuning in to this fantastic interview with David Hay. Before we wrap up here with our final sets of questions for David, I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report. I'm positive you've been enjoying the conversation David and I have been having. Please let him know, hit the like and subscribe button, and leave a comment below the video. David, before we started recording, I mentioned the asset ranking lightning round. So let's finish off our discussion there. I'm going to ask you to rank a few assets as a buy or a sell. 100 being an extreme buy, 1 being an extreme sell. You could fall anywhere you want in between. Then just give 1 or 2 sentences as to why you take the position. We'll try to roll through the assets fairly quickly. And then if you're not following any of the assets, that's fine. We could just move on to the next one. All right.
Well, I'm going to be 70 next month, so I don't really move at the speed of lightning anymore. I never actually did. But I'll flip it around and I'll go with the least likely or least light asset class first, which in my case is the home builders, XHB. And it's really quite an odd anomaly. In fact, the Wall Street Journal had an article on this today, just coincidentally, because I was going to write this up, is if you look at lumber prices, they've been crushed. I have a chart in here, if we want to look at it, but just, trust me, they're down like 67% from their peak back in 2021. They're even down about 24% here recently. And yet the home builders are basically trading at an all-time high, or very close to an all-time high. And to me, that makes no sense. This is one of the worst setups I've seen for the housing market in terms of prices that are just way too high for people to afford. And kind of the proof of the pudding, I don't know if you know this, Gary, that this is the only time that we've ever seen new homes substantially below existing home prices.
40,000, I believe.
Pardon me?
I believe it's about 40,000 differential.
You're exactly right, 40,000. But that's official. So my buddy Adam Taggart had Melody Wright on here recently. She made a great point that I've been suspecting, which is that does not include all these freebies that the builders have to move their merchandise. So that's about another 40,000, according to her. I'm just repeating what she's saying, but it's mortgage buy downs, free appliances. They even they'll pay property taxes for all. They do all kinds of things to move their homes. So that's probably more indicative of where the real clearing price is. But that's a new home. Let's say that instead of 435, you're at 355. That's the $80,000 difference. Then that means existing homes could go down, $100,000. From 435 down to 335, because that would not be much below a new home effectively right now. And so I look at these builders and think, what are people? I mean, I know Buffett's put some money into him, but it was kind of chump change for him, $1 billion out of $340 billion he's got in cash. So anyway, I'm negative on home builders. I think there's just so many negative. I mean, here's
how about I roll through the asset classes that I have, and you can score each one individually. Sure. Okay, so let's start with gold, physical gold. 1 to 100, is gold a buy or a sell, and why?
Well, that's kind of a binary situation. I guess I would say on a near-term basis, it's a buy because it's broken out and because it has all these other supporting forces behind it. So I'd say it's a buy, but I don't think it's a table founder.
Would you put it at 70, 80?
Something like that.
Okay. What about gold miners, 1 to 100, and why?
I probably put that at about the same rating. There you can kind of be more selective. It's gold, you've got one choice, but with the miners, you can say, well, I'd say maybe an Eagle is maybe too expensive. It's moved an awful lot and it's selling at a high multiple, but Wesdome looks very cheap. So I think you just it's kind of a little hard to throw them into the same pot. But
yeah, fair enough. All right,
there's opportunities.
Physical silver, 1 to 100, and why?
I'd probably rank that a little higher, maybe 80, because it's a more recent breakout. And if you look at the history of silver, it tends to lag gold, and it's really cheap. Well, I know that it's a bit unfair because it's got industrial demand characteristics. It's also got military demand characteristics, which are very strong. So anyway, I'd say that's probably an 8 on your scale of 1 to 10.
Okay, we'll go 1 to 100 though. Okay, so we'll make that an 80.
80.
Yeah. So let's go to copper, 1 to 100.
I'd probably put that one more like a 90. I think given the pullback that it's had, and I still think that the demand story is really good. I think a lot of people don't realize that hybrids use a lot of copper. And while EVs are disappointing, that's kind of the bear story here on copper right now, is EVs are kind of flatlining or even going down if you're Elon Musk. But if you're BYD, business is great.
That's booming. All right. Uranium, the metal.
Well, I would have said 100, back a few months ago. We did, really table pound on that one, but it's gone from 13 or so to 18 and a half on the SRUUF, the Sprott US version of that. But I think it's going a lot higher. I mean, I think it's a little ahead of itself right now, but it's just resting. And there's, the inability to find new significant uranium deposits is probably more acute than it is on any of these other metals. And the demand is
even the existing producers are not meeting their expectations of production.
Exactly.
Yeah.
No,
So
I'm a big, that's my favorite metal long term, actually uranium, but it hasn't been
okay.
a lot lately.
So you said you would have been 100. What would you be today at?
I'd probably say 80 with that one.
Okay.
Or
Let's
800,
move.
or
Do you
800.
make a distinction between the
Oh, you said 80.
uranium?
Sorry.
No problem. Do you make a distinction between the metal and the miners for uranium?
Yes, I have a hard time with the miners, to be honest with you. I mean, Cameco looks pretty expensive and they might have a short position that could be costly to them. A lot of these other miners, I mean, NXE supposedly has the best new uranium deposit coming on. I do own some of that. I do own some Palantir, but they've got problems over in Africa. And it's not like the energy area where there are just so many great companies that trade so inexpensively. And even the miners were, there was so much negativity towards the gold miners, but the reality is there were a bunch of them that have continued to perform very well even before this year. I mean, from an operational profitability standpoint, like AEM and AGI to name two.
All right. Let's go over to oil, 1 to 100, and why.
I'd say that's pretty close to 100, even though it's acting horribly. It seems to have no friends, but that's when you get the best returns. And certainly that's right where gold miners were just earlier this year. So I like it a lot. I think that there is the IEA, which is the leading authority on the oil market for whatever bizarre reason, because they're wrong like always. They keep telling everybody that there's a glut of oil and that the U.S. is going to continue to grow its production, where actually even the Permian is starting to hit the wall. So I think there's a huge misperception that we've got this glutted market. They just keep saying the same thing over and over again. It just isn't true.
Do
There's
you think
actually, look at the inventory levels are low. They're not high.
do you think shale is starting to roll over?
Yes.
You do. All right, let's move over to the NASDAQ, 1 to 100, and why.
Yeah, that'd probably be in the 2 to 3 zone. There were some that I thought that made some sense, like Google, but it's run here lately, and so I don't see much good there. I think I maybe don't have time for a visual, but I've got one in there about these momentum stocks. I mean, that part of the market has gone so crazy, and prices have gone so vertical that I think that's where you're going to really get a bloodbath. Not so much the Magnificent Seven. I don't think they're particularly ridiculously overvalued, but there's an awful lot of companies out there that are trading at 30 times sales. Forget earnings.
Okay, S&P 500.
I'd probably rank that a little bit higher, maybe instead of 20%, maybe 40% or 20 to 40. But I think we're in a period where the S&P is going to produce for this whole decade basically zero returns and maybe nominal, little positive, but real negative. It's a very, very expensive market. I'm not saying anything nobody realizes. There's, of course, no human can predict when it's going to change. But I think
There's a lot
I
of
mean, just look at what the insiders are doing. Insider selling is ferocious right now.
yeah.
Pretty good warning sign. And my buddy Jesse Felder is picking up on these Hindenburg and there's another one that's similar. Titanic syndrome is the readings are coming off in clusters right now, and those ones, if they're isolated, they don't mean too much. But when they happen, in a collection and an array, then that's much more of a red flag.
There's a lot of boomers, a lot of retirees, pension funds that will suffer if for the next decade the S&P is not producing any returns.
Right, which it's happened before. It happened from the mid 60s, early 80s. It happened from 2000 to 2013. To say it's not going to happen again, I think is naive. I think, frankly, we'll be doing good just to kind of be going sideways. But I think to go sideways, that's going to require a fair amount of policy support. But, you can make money in stocks outside of the U.S., and those markets have lagged. I think the emerging markets have had an impressive breakout here recently, and we particularly like emerging market debt. You can buy these closed-end funds that give you exposure to some of the countries like Brazil, where Brazil's got 14% interest rates and 5.5% inflation. Got a huge real interest rate. So I think that's it, particularly for your older investors that are looking for cash flow. And there's one fund, EDD, that's had an impressive breakout, multi-year breakout, and it yields about 9.3%.
Okay. Let's move over to short-term treasuries, 1 to 100, and why.
I would say, probably 80 there. It depends on what you're using them for. If you're using them as a parking place, I think they're great. And given what's going to happen to interest rates, you could kind of play that relatively short area, maybe 2 to 3 to 4 year maturities, where as the policy rate, Fed funds rate comes down and goes to say 2%, then if you're in there at 3.5, you're going to look pretty good from a yield standpoint. You might get a little bit of a capital gain, but I think for your best performance, you probably have to go with something like AGNC that I mentioned earlier, the mortgage REIT.
Now, what about long-term treasuries?
Yeah, not so much. Other than, I realize they can be trading rallies. There's quite a short position on the 10-year Treasury. I did hear the CEO of PNC Bank on CNBC this morning. You would think that he would be kind of a rah-rah cheerleader for the bond market, but he said he thinks the 10-year is going to go to 5.5.
Wow.
He could be wrong, but I think ultimately the timing is, of course, completely unpredictable, but I think he's going to be right here before too long, like, over a 1 to 2 to 3 year period.
Well, that's going to make mortgage rates even more challenging. On a scale of 1 to 10, each representing a percentage, where do you see inflation ending by the first quarter of next year?
By the first quarter of next year, I would say it's probably going to be a little bit softer than it's running right now, but I don't think that will persist.
Okay. And 1 to 10 probability, are we headed into a recession by the end of this year?
I'd say 60 to 70 on that one. I don't have a lot of conviction in that. I mean, I do realize that there's a lot of liquidity in the system, but I do think we are getting late in the liquidity cycle, which would be another reason to expect, especially as we go into next year. I think the odds of recession get up there closer to 80 to 90.
Okay. And finally, the recommended portfolio allocation, it's been 60-40 for so long, but nobody really has ever recommended any gold or gold equities or anything related to precious metals. Do you recommend now for folks to hold even any allocation of precious metals or related equities? And if so, what would be a viable position allocation?
Well, it's a bit challenging because they move so much. I can tell you that we were, like 5% in gold miners, and now, we're probably 8, 9% because they move so much. So we're scaling back a bit, but still retaining a significant position. I hope now if somebody's just coming in with fresh money, I think you got to buy, because I think the story is so compelling long term for these things to go higher. I just think you have to do it gradually. And so often it seems like when people really get excited about precious metals, they do it, after a big move. And then when there's just a correction, still in a bull cycle, they panic and they sell and they miss the next up leg.
Are you still writing your Substack, Haymaker?
Yes.
Okay, great.
You mean you don't read that every day when it hits your inbox? Gary.
I really just wanted to confirm for the public here. I did that that was a host question on purpose.
All right.
Work with me. All right.
Yes,
So
we do a
David,
daily. We do a daily it's a very short read. It's like a one pager. Today was on the adjustment downward, the 911,000 that jobs you indicated. And then we do Making Hay Monday, which is longer and it's probably 10 pages, but it's got a lot of specific trade ideas in it. So it starts out macro, then it goes to the individual or micro ideas. Then we do more of a think piece or kind of philosophical one on Fridays, the Haymaker. And a fair amount of this is even free. I mean, you can get in there and see up to the paywall and get at least a taste for what we're talking about.
Awesome. All right. Well, would you give a key takeaway that you want the viewers to walk away with, keep in mind regarding today's economic market or monetary situation, and then let them know how they can connect you and find the Haymaker Substack?
Yeah, as far as key takeaway, it's just my belief is that most people, and I'm talking about my generation, let's face it, most investors are boomers. And we've gotten older, and yet our equity allocations have gone up and up and up. And I just think everybody should be looking at their equity weighting and really determining, am I too exposed to stocks for my age and my net worth? I mean, obviously wealthier people can have more. They could be, instead of 60-40, they could be 80-20, 90-10, whatever. But even if you do have a high level of risk tolerance, I think right now is a good time to be paring back. And if you have little exposure to precious metals, I would be very on alert for the next correction to try to rectify that. So, and I guess the other thing I would say is breakouts and breakdowns. I'm just astounded at how many people, bright people on CNBC that pay lip service to breakouts and breakdowns, but they don't really act on them. Josh Brown is probably one of the guys that's best at doing that, and he's had some great stock picks. So pay attention to those, and it can get you out of trouble too. Keep you out of trouble if you look at the ones where they're taking out multi-year support. That's usually a great sign to exit stage left. So as far as how you can find us, we're at Substack, Haymaker. I think there's an underscore there or something, but if you just do Haymaker Substack, you'll find us.
Okay, I'll make sure I have it up on the screen correctly. It'll also be in the description area to be able to click through. Everybody go over to the Haymaker Substack. It is worth your time. I do read it. David, thank you for coming on to Metals and Miners. I always love our conversations. You're always so generous with your time and analysis and ideas. I look forward to having you back on sometime soon. And everybody else, thanks for watching.
Thanks, Gary.
Before we wrap up here with our final sets of questions for David, I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report.